You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose and the Loose. I hope you are doing well on this Wednesday. Today, we are going to talk about a small/big company, kind of ironic, Dominion Lending Centers, DLCG.TO. And if you got that wrong on the ticker, don't worry, I'll put that in the show note. So, and I'll keep talking about Dominion instead of like DLCG, just sounds a little bit better, right? So Dominion was put on my radar by one of my members at Dividend Stocks Rock. So I just love to connect with all my members. And I mean, I know that a lot of you guys are listening. So whenever you have questions or anything, never hesitate to send me an email and then we can discuss. So just like interesting company because it is a small cap, actually almost an ultra small cap, because the company more than doubled in price over the past 12 months, and yet the market capitalization is 700 million, a little bit more than 700, but I mean it's a small cap, so whenever you listen to this, it's going to be around this. Paying a yield of 1.75%, so not too bad. Just got the first dividend increase in several years as well. So anyways, it was submitted to me for a review. Never heard of that company, so I was like kind of curious because it is a small cap, but it is also the largest mortgage broker network. So what they do, well, think of the middlemen. Like they are connecting borrowers with lenders. So they do have like this massive mortgage broker network, and they just make the connection and they take the fee on those mortgages. So what is great here is they are running a franchise model, so they just get those royalty payments from those like brokerage firm, and it's an asset light model because they do not carry on the loan. They really just take a connection, like they take the fee out of the connection between the borrowers and the lenders through their network. So smart way to benefit from the housing market in Canada and not necessarily going after like against bank, because a lot of banks love to do business with mortgage brokers, actually. Kind of ironic, but it makes their life easier. So they don't have to pay unless they get a client. So they see that as a pretty good deal. And once they get the client in the bank, well, they want to sell all the other products. And over time, the mortgage business, like the mortgage itself, the product has become a commodity. There's not much about the service, right? I mean, you're just going to underwrite the loan, you're going to give a good rate, and then you're going to move out. So mortgage lenders are really good at doing this specific task, and then Dominion is taking like the cut out of this, and then the bank, I mean, they're just getting the loan after that. They're making money on the interest. And on top of that, they have a great opportunity to offer more products. So that kind of makes sense. It's kind of like a necessary component in the ecosystem. So in terms of growth vectors, what do we have? Because we just like laid out the playbook. So the growth vectors, of course, the thing is, the more they have, like the more brokers they have in their network, the better it is. So they can grow by acquisition, acquiring like small brokers firm, which is great. They can also use technology to improve the service, make mortgage brokers' life easier. So if they can underwrite like the loans and complete the application a lot faster, it's going to be also easier for them. A lot of good things have happened over the past few years in this industry, so they can actually add more services and grow this way as well. And naturally, if there's a lot of volume of transaction, that's great for Dominion. Or if interest rate goes down, there's going to be like a bump in the refinancing. So those are like the ways that they can grow. In terms of economic mode, well, being the largest mortgage brokerage network is a very good thing because they have the brand, they have the scale, they have the relationship, and once those brokers they are inside that network, it's kind of like, it's not impossible, but it makes it a sticky business to just like keep those system up and running. I mean, you think of like you are an independent broker, mortgage broker. You deal with Dominion, you go into their system, and once everything is like in their platform, it's just easier to deal with that than just changing for another one. And there's not necessarily a big like bonus to get with another platform as well. So it's not a huge economic mode, but it's still relatively good. Now, I mean, we have a pretty good company. The fact it's a small yield, not a small yield, but a small cap, I'm a bit reluctant on this one. In terms of like the revenue and the earnings, it has not grown that much over the past 5 years. So a lot of people are getting very excited as of late. But I'm not too sure I get the hype when I look at the numbers. Keep in mind, if you look at the earnings per share growth, you will notice that there's a big loss that was generated at the end of 2024, but that was because they paid back preferred shares. And those preferred shares, the value was higher up, so that's what it generated a loss in their financial statement. However, they paid off like a debt, so it's actually a good thing, and it's going to resume. But if I look at the EPS trend before that, it was not really growing over the past 3-4 years. The dividend just has been increased, but before that, I mean, they were like paying the same one since 2022. They were not paying a dividend before that. And one thing that is fascinating is if you go back in time, like a while ago. I mean, right now the stock price is around $9. Did you know that a while ago, before the financial crisis of 2008, so in 2007, the stock price was almost at $90. So probably it was a completely different business model back then, but it was a huge company that got destroyed literally for several years, and now it's going back up. But just to keep in mind that, I mean, in 2019, the stock price was at $1. That's kind of crazy. Right now it's back at $9. So I don't know the story about what happened back then, but just wanted to highlight that as another risk. Of course, if there is a slowdown in the housing market, if it gets stables, I mean, they make money on volume. If the volume goes down, it's going to be like a big stop. So that is also one downside for Dominion. Finally, in the risk, being the middleman is a good and also a bad thing, because when you think about that, if you're trying to take more money and grow this way and charge a little bit more, well, banks are just gonna cut you up and then go directly after the client. So the middleman role works as long as banks are happy to not get the full profit from that mortgage inside their pocket. So if you get too greedy, you're going to hit a wall as well. So it's important to create that kind of balance and provide as service as much as possible. Looking at the dividend growth perspective, I mean, it's kind of hard to say where it's going to go. There's one dividend increase in years. And before 2022, the company stopped paying a dividend for a while after the financial crisis also. So not exactly a super solid dividend grower, actually not at all. So I would say, yes, it's fascinating that the stock price skyrocketed like this, but at the same time, considering the current economy, I don't know. I would find it hard to pull the trigger on this one. The dividend triangle is not that strong in my opinion. The fact it's a small cap that just had a big jump, I'm not too sure it's going to continue. And now thinking that the tariff war is still ongoing, that we have not gotten the full impact of all of this on the on the housing market and on the Canadian economy, I don't know. There are too many uncertainties to my taste. I would see this as a speculative play if I would add it to my portfolio. But at this point, I'm going to pass because of those reasons. But doesn't mean that you should. I just wanted to highlight an interesting business model, asset light, that is kind of interesting. Got a lot of traction over the past 12 months. And yeah, so then it's up to you to do your due diligence, but that could be an interesting kind of like Omeron or strikeout type of plays. So right, Moose, that's enough for today. I'm going to leave you at this point. We're going to talk again on Friday with the summer schedule. So until the next time, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.